Hi! International Financial Reporting Standards, or IFRS, change quite frequently, and many changes are effective for the period starting 1st January 2013 or later. Is your company affected by these changes? Do you need to watch out when preparing your IFRS financial statements for 2013 or later? Well, in this video, we'll look at 5 biggest changes in IFRS that apply from 2013 and 2014. I'm Sylvia of IFRSbox.com, and I help people understand and simplify IFRS. I have created 2 courses and lots of free IFRS materials, so you're welcome to check them out at IFRSbox.com. Well, the change number 1 is the amendment of the standard IAS 19 employee benefits. The standard itself is quite complex and there are a few changes in it, but the biggest one is probably the change in accounting for defined benefit plans. Well, just to refresh, accounting for defined benefit plans is very complex because it involves incorporating some actuarial assumptions, estimates, application of projected unit credit method, discounting, and many other things. As a result, some differences may arise. Well, before the amendment, these differences were actuarial gains or losses, and basically, you could apply so-called corridor method. Well, what that means is that if the accumulated unrecognized actuarial gains or losses exceeded 10% of the greater of the defined benefit obligation or the fair value of plan assets, a portion of that net gain or loss is required to be recognized immediately as income or expense in profit or loss. Well, later, the option to recognize actuarial gains or losses to other comprehensive income in full was added. After the amendments, valid from 2013, these changes are called remeasurement of defined benefit liability, and you don't need to worry about any corridors because new IAS 19 requires recognizing them fully to other comprehensive income. So effectively, it's a simplification for us accountants. But if you used corridors before, then watch out your equity because you'll see more volatility there due to immediate recognition of full remeasurement, and you'll need to explain that to the shareholders. Another change in IAS 19 is clarification related to termination benefits. Well, the accounting treatment didn't change that much, but now IAS 19 states that if the benefit requires future periods of service from employee, then it is not a termination benefit. Well, let me explain that. Imagine a plant that is going to shut down and all employees are offered a bonus of €15,000 and thereof 5,000 is offered as a compensation for termination of employment before retirement date by the employer. But as there are some operations necessary to complete shutdown safely, employees are offered additional €10,000 in return for staying in employment for another 3 years until the closure is finished. Here, in line with new IAS 19, the first portion of this bonus is typical termination benefit because it is provided in return for termination of the employment. The second portion is a post-employment benefit, while more specifically defined benefit plan, because it is provided in return for future employee service. So, you would need to apply different accounting treatment to both parts of this bonus. If you'd like to know more about IAS 19, please watch our summary video right here in this channel. Of course, there were some other changes in IAS 19 too, so if interested, check our web for more details. Another big change in IFRS is the new standard IFRS 13 fair value measurement. Before this standard, the guidance on fair value was spread throughout all the standards and it was often conflicting. IFRS 13 is valid for the period starting 1st January 2013, and its main objective is to define what the fair value is, then to set out a framework for measuring the fair value and to require disclosure about fair value measurement. IFRS 13 requires the use of principal market to measure fair value if possible. Fair value is determined based on the unit of account, so no volume discounts are taken into account. Fair value of non-financial assets is determined by reference to the highest and best used, not current use. And IFRS 13 sets a few valuation techniques that you should apply. And also, it categorizes the inputs to valuation techniques into 3 levels of fair value hierarchy, level 1, level 2, and level 3. If you're interested, watch the video with summary of IFRS 13 right here. The third big change, valid for the period starting 1st January 2013 in IFRS, is the new standard IFRS 10 on the consolidated financial statements. This standard partially replaces IAS 27, consolidated and separate financial statements. So currently, IAS 27 applies only for separate financial statements. The main change of IFRS 10 is new definition of control. Control exists when an investor has all of the following. First, power over the investee. Second, exposure or rights to variable returns from its involvement with the investee. And finally, the ability to use its power over the investee to affect the amount of the investor's returns. So now, after the change, you maybe find out that some of your investments do not meet the definition anymore, so you don't have to consolidate them. Or the opposite can be true. Some of your investments may fall under the definition of control, and you might need to start consolidating them. In other words, the composition of the group may significantly change. Well, if you wonder whether it's also your case, IFRS 10 contains the whole guidance on the control. Another change in IFRS 10 applies for the period starting 1st January 2014 or later. IFRS 10 introduces a concept of an investment entity, which is an entity that obtains funds from one or more investors for the purpose of providing those investors with investment management services, and commits to its investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both, and measures and evaluates the performance of substantially all of its investments on a fair value basis. So, if you identify that your company meets the definition of an investment entity, then this investment entity or your company doesn't need to consolidate its subsidiaries in line with IFRS 3, but instead measures them at fair value through profit or loss in line with IAS 39 or IFRS 9. Change number 4. New standard IFRS 11 joint arrangements. This standard replaces IAS 31, interest in joint ventures. Older IAS 31 classified joint ventures into 3 categories: jointly controlled operations, jointly controlled assets, and jointly controlled entities. And IAS 31 prescribe accounting treatment for each of these categories. IFRS 11 classifies joint arrangements into 2 categories only. The first one is joint venture. Here the parties that have joint control of the arrangement have rights to the net assets of the arrangement. So some separate vehicle is usually established. Joint venturer should account for its share in joint venture using the equity method. The second type of joint arrangements is joint operation. Here, parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities relating to the arrangement. A joint operator accounts for the assets, liabilities, revenues, and expenses relating to its involvement in joint operation in accordance with the relevant IFRS. So, as a result, the proportionate consolidation method is not permitted anymore. So, if you have used it, then you need to change your accounting policy. Big IFRS 13 change represents also another new standard, IFRS 12, disclosure of interests in other entities. And as the title indicates, this standard prescribes a number of disclosures for interests in various entities, including subsidiaries, joint arrangements, which are joint ventures and joint operations, associates, and also unconsolidated structured entities. Well, these are structured entities that are not under the control of the reporting entity, for example, other investments that are not consolidated. Company must include a number of disclosures about these entities in line with IFRS 12, while you need to disclose summarized financial information about these entities, then also judgments used in determining whether the control exists or not, etc. So now you know the 5 biggest changes in IFRS applicable for 2013 or later. Thank you so much for watching this video, and if you want to take your IFRS knowledge a little deeper, check out our free mini course by signing up for email updates at ifrsbox.com. You'll also receive the ebook Top 7 IFRS Mistakes. Thanks again and have a nice day.